The last time you bought a concert ticket, you were not a customer, you were a captive. And the company that built the cage is on trial this week in Manhattan. The U.S. Department of Justice and 40 state attorneys general want to break this company apart. This is not a consumer complaint. This is the most significant antitrust action in the American entertainment industry in a generation. And it starts with understanding exactly how the machine was built. Today, we open the corporate ledger, the 2010 merger that regulators approved and immediately regretted, the consent decree they violated, the venues they threatened, the artists they trapped, and what happens to your concert ticket price if the government wins. In 2010, Live Nation, already the dominant concert promoter in North America, merged with Ticketmaster, the dominant ticketing platform. Regulators approved the deal on one condition: a consent decree prohibiting Live Nation from using its concert power to coerce venues into using Ticketmaster. That promise lasted approximately 18 months. By 2019, the Department of Justice was forced to sue its own consent decree. Internal emails obtained during discovery showed Ticketmaster employees admitting they, quote, turn a blind eye as a matter of policy to broker misbehavior. The DOJ appointed an external compliance monitor. Live Nation signed a new agreement, and then continued. By 2024, Live Nation directly managed over 400 musical artists. It owned or controlled more than 265 concert venues across North America. Through Ticketmaster, it processed approximately 80% of major venue ticketing. Promoter, venue owner, artist manager, ticketer. One company. Every side of every transaction. The DOJ describes what it calls a feedback loop. Live Nation promotes a tour. The tour needs venues. Live Nation owns the venues. The venues need ticketing. Live Nation owns the ticketing. The ticketing generates fees. The fees feed back into Live Nation's balance sheet, collected simultaneously from the fan buying the ticket, the artist performing, and the venue hosting the show. The DOJ calls it double dipping on all sides of the same transaction. In 2021, Barclays Center in Brooklyn switched its ticketing contract to SeatGeek, a competitor. 2 years later, it switched back to Ticketmaster. Barclays maintains it was pressured, that Live Nation made clear: use Ticketmaster or lose access to the artists Live Nation controls. Live Nation denies this. A federal jury in Manhattan will decide who is telling the truth. In 2022, Live Nation introduced dynamic pricing to concert tickets, a system where prices algorithmically surge based on demand. The same mechanism airlines and hotels have used for decades, now applied to concert culture. DOJ attorney David Dahlquist told the jury this week that Live Nation has the highest concert ticket fees in the world. When venues switch away from Ticketmaster, fees drop by an average of $3.82. When they switch to Ticketmaster, fees rise by $4.33. The complaint also accuses Live Nation of a retaliation playbook, threatening venues in Minnesota and Texas that considered signing with SeatGeek by signaling that desirable tours might not come their way. Exclusionary tactics, market foreclosure. The vocabulary of antitrust law applied to the business of live music. Before the legal arguments, before the antitrust theory, there is a simpler reality. The average American concertgoer now pays roughly 30% of their ticket value in fees alone: convenience fee, order processing fee, facility charge, service fee, each line item appearing at checkout after the emotional commitment to buy has already been made. Economists call this drip pricing. Concert fans call it something else. In November 2022, Ticketmaster opened pre-sale for Taylor Swift's Eras Tour. The system crashed. Millions of fans were locked out after waiting hours in digital queues. Ticketmaster later canceled the general sale entirely, claiming a cyber attack. Swift herself described watching it as, quote, excruciating. Within weeks, the Senate Judiciary Committee opened a bipartisan hearing. Even senators who had never discussed antitrust policy were suddenly, urgently, asking questions about Ticketmaster. The Swifties had done what 30 years of consumer advocacy could not. This is not a new story. In 1994, the rock band Pearl Jam testified before Congress, 32 years ago, saying Ticketmaster refused to lower ticket prices and fees and that no alternative existed. The case was dismissed. Ticketmaster's dominance only grew. From 1994 to 2026, one company has outlasted every regulatory attempt, every congressional hearing, every consumer backlash. Until this week. To win this case, the Department of Justice must prove three things. 1. That Live Nation holds monopoly power in a clearly defined market. 2. That it willfully acquired or maintained that power through anti-competitive conduct, not just through superior business skill. 3. That this conduct caused real harm to fans, artists, and venues. The jury of 12 New Yorkers selected this week will decide. The trial is expected to last 6 weeks. Live Nation's attorney opened by calling the company a, quote, fierce, lawful competitor in a competitive market. The company argues that its ticketing fees primarily flow to venues, not Live Nation. That competition from SeatGeek, AXS, and others is real, and that the Taylor Swift incident was caused by a cyber attack, not monopoly power. A 2023 poll found that 60% of Americans supported breaking up the company. But polls do not win antitrust trials. Evidence does. If the government wins, Judge Subramanian, a Biden appointee, will determine the remedy. The most significant outcome would be a forced divestiture. Live Nation required to sell Ticketmaster, unwinding the 2010 merger entirely. Scenario 2. A structural remedy short of full breakup, behavioral restrictions, new consent decree, independent monitoring. Scenario 3, Live Nation wins, the monopoly continues, and the next Pearl Jam testifies before Congress in 2056. For investors, Live Nation stock has absorbed this litigation for 2 years without collapse. A forced breakup scenario would restructure the company's revenue model fundamentally. A behavioral remedy would likely be absorbed with minimal share price impact. The market is pricing in a partial government win. Watch the testimony from SeatGeek and Barclays executives in week 1. That is where the factual record will be built or broken. The live music industry generates over $30 billion annually in the United States. For decades, one company has sat at the center of every transaction in that market, as promoter, venue operator, artist manager, and ticket seller simultaneously. Whether the Department of Justice wins this trial or not, the structural question it has placed before a Manhattan jury will define how regulators think about vertical monopolies in the entertainment economy for the next generation. This is Boardroom Economics. We will be following this trial weekly. The next video goes deeper into the financial architecture of Live Nation's revenue model and what a divestiture would actually look like on a balance sheet.